Hey, hi everyone. Hope everyone's doing well. I think today both Spendflo Recur team are here. We wanted to discuss with you, given the current macro, right? Like it's on everyone's mind, right? Like what's happening, things are changing dynamically. It was only last year when capital was going all around, people were growing very fast, everything seemed to be hunky dory. And I think 6 9 months down the line, we've seen the times totally flip, and we wanted to discuss certain strategies, in terms of what's the best way to maintain yourself in terms of, protecting your runway, growing your business in the current macro, both from a capital standpoint of view and B, efficiently spending on various initiatives that the spend flow and the record team, Sid and I will cover that, various facets. And we would love to make it as interactive as possible, right? Like, because this is an open forum, we just want to have a chat with you guys, what's on our mind, etc. Obviously, set context, but would love to discuss, any specific things, anything that you want to discuss during the webinar where we can add value. The idea is to learn together from this webinar, right, and implement better strategies.
Awesome, yeah. Thank you for that. Thank you for kicking it off, Eklavya. And folks, feel free to ask us any questions in the chat as well, and along the way. It'll just help us also answer anything, but also maybe have a discussion about anything that you particularly need answered from us. So before we kick it off, I thought we could just do a quick introduction. So at Spendflo, we help companies buy, negotiate, and renew all their SaaS subscriptions and guarantee savings for a lot of high growth companies along the way. Maybe you want to kick it off?
Yeah, so at Recur, basically, we are a fintech platform that facilitates non-dilutive growth capital for your businesses. And you can save, the two most precious things, that is equity and time as a founder. So that's what we focus on, specifically suited for recurring revenue and SaaS companies, is what we have started this platform for now.
Awesome. And just a quick background about me as well. Hey, folks. Just a quick background about me as well. So, prior to starting Spendflo, I used to run the business operations team for a high growth company called Volta Charging based in San Francisco. And during my time there, ended up buying a lot of SaaS and also working with finance teams working with a lot of finance teams to understand, hey, how we operate, how do you actually capitalize yourself, but also how do you actually procure really smart to enable savings for as you scale. Anything related to SaaS and how you buy and negotiate and also manage them, feel free to ask me any questions. And Eklavya is the expert on the other end.
No, thanks, Sid. And I'm sure people will have a lot of questions because that's the need of the hour, right? Like all of us keep on taking a lot of tools, but then later realize, that the cost is gone. And we ourselves would be keen to hear that your views there, to be honest. So a little bit about myself. I've been an investor prior to starting Recur Club. So I worked on the structured credit and the private equity side across multiple private equity and global pension funds. Was covering India, Singapore, Australia as markets to invest in. Started Recur along with my very good friend and batchmate from my MBA days, who's an expert in SaaS as well. He was working with Gartner. So yeah, we are here. We have been working close to around 300 plus companies in the last 1 year, and would love to help in whatever we can possibly to all SaaS companies to and we can chat separately during the session. So please feel free to ask anything and talk to the man.
Awesome. So just before we get started off as well, can you give us a picture of what's actually happening? Because even I'm confused, right? Every time I go on CNBC, or every time I go on YouTube, or every time I look at Twitter, it's like I have different pieces of information. It feels like the market's back up, the market's back down in terms of the public markets, and then you have travel at an all-time high, unemployment at an all-time low, but at the same time everybody's talking about their inflation. it's just really confusing, right? Because this hasn't been seen before necessarily. So can you give us an understanding of how it affects companies like us?
No, absolutely, and I think we've all, as you rightly said, right, all of us hear in the news that multiples are down, valuations are down, etc. But what's the root cause? And always when we discuss this, people try to answer, till when will it last? So it's very important to understand what the core reason is, and by when do we think this would improve, linking to those reasons. So I'll spend a few minutes here, which is going back to our macro days. So post COVID, right? Like COVID saw obviously economy slowing down and dying down everywhere. The central bank came in globally, right? Like injecting huge amounts of liquidity. There was more than $1 trillion of capital injection globally being done in various forms and shapes. And what typically happens, whenever there is excess liquidity, like in 2008 crisis, or any crisis, whenever there is excess liquidity pumped in by central banks, it typically starts to go first to, risky assets or commodities, etc. Right? And hence a lot of capital started flowing into obviously the commodities as an asset class globally, but to, we see equity money. So we saw a lot of people raising crazy amounts of equity money last year, especially SaaS companies that hit all-time high records. That was obviously to do with the growth that they were witnessing, because of the tech getting in favor and SaaS adoption increasing. But it was also, we saw that it was not natural, right? Like it was much above what people were saying that valuation multiples are very high. That is to do with a lot of liquidity in the system, right? Like it is a supply and a demand game at the end of it. So a lot of money flowing in to chase quality companies, but at crazy multiples, crazy valuations, etc., right? Which was above and beyond. And what has happened as a result, right? And similarly to commodities, right? Like that always happens. Crude oil. Obviously, we saw some external macroeconomic shocks, like the Ukraine crisis in between thereabout, which further led to that. But typically, we saw the inflation levels like highest in the last 40 years that we've seen. That is crazy. That you see on the chart here, the CPI inflation has suddenly shot up, like, from 0% to like almost close to 8% in the US and similar levels globally. What happens as a matter to that, right? Like to combat this inflation, typically central banks, follow these and they hikes and hike rates to pull off some liquidity from the market so that the inflation can cool off, right? All the money that was going into commodities, etc., can be pulled off, but obviously it comes with a cost, right? As soon as you take off liquidity from the system, it starts impacting growth, right? Because money in circulation reduces. So is it going to the high impact value sectors or not to get that growth going? I think that is very, very important to see. So this is a very precarious and a tricky situation, for central banks globally. And as you see, the central bank rates were almost close to 0% in the last month and a half to they've increased that to 3%, right? Like that's a drastic increase. But is it the stop or is it the end? Definitely not, because you will see in the chart that the federal funds rate here, typically follow the inflation chart, and we see on the extreme right in 2022, the inflation has shot up 3%. The rates still at 3%, right? There's a huge gap. So don't be shocked that the rates don't go further. There is definitely, room, and central banks would do that, obviously in a calibrated manner. So this is not going to stop immediately, right? So this is going to stay for at least 6 to 9 months till the time, rates catch up to inflation, liquidity starts to get pulled off, inflation starts to pull off, and those two rates kind of coincide, right? Till you find an equilibrium between inflation and growth.
So what is your what does that future look like, right? Like, how long will this last, and what do you think this future look like? And will we ever see 2021 fundraising markets again?
Yeah, I think it's a very good question because the maximum demand that came in due to liquidity came in to the high growth sectors, right? They always benefit. 2021 was, I would say, much above equilibrium, to be honest, right? For any businesses. But having said that, and hence the liquidity pull off is also affecting the growth sectors, like our sectors, right, the most. And hence we have seen the valuations going down the maximum there. Because, fast growing sectors, this is just simple maths that you discount your future cash flows to get to a valuation today. And if you're a very fast growing company, any change in interest rates that you discount with has a major impact, right? So I think that is what we started to witness. How quickly, obviously, we'll come back, right? These are cycles. These are macro. It is not that it has happened. It will never happen again. These are cycles that will keep on happening and seeing. It used to happen in a gap of 20 years previously. That cycle, I think, is reduced to 8 to 10 years now due to different ways. It may go down to 5 years, right? Like at the pace at which things are moving, I think, but these are cycles. At the end of the day, we need to realize the faster they come, the faster they end. So one needs to be very pragmatic and just not stop, say, hey, the world is stopping. No, let's focus on our business. And I think the fundraise market will come back very quickly. And the reason for that is, a lot of VC funds also have raised a lot of capital in the last 1 or 2 years. They're sitting on dry powder, wanting to chase quality companies. So they just can't, get away with that. So we have seen the flight to quality that is happening, right, in the current market scenario. And I think it will come back sooner rather than later. It is very difficult to predict, when exactly. But I think based on what global funds have been saying and the chart here, I think seems like a 9 to 12 months kind of a journey before things start getting back to normal. But the world is not stopping, right? We should really.
But it's interesting. It's interesting you say that, right? Like in another 5 years, if it's back, or another 3 years, it's back. That dictates that actually we have to have. We'll have to extend runways, right? Or we'll have to actually operate a lot more efficiently than we at least were in the last couple of years. So it's a great segue into the next point as well, right? So we've all seen this. This is just like, I think a lot of folks have seen this. This is like a copy of David Sachs's post on what are the key metrics that you need to have in order to actually fundraise in this downturn, right? Like, so what are the metrics that really work? And it speaks to it, right? Like, so if you could see, sorry, there's a mistake. This is bad. Sorry, this is not great again. This is bad. Great metrics over here look like, actually, let's start with the worst case, right? Like, so if your growth rates are under 2x year over year, right? Like growing less than 2x year over year, and your gross margins are under 20%, and your net dollar retention is under 100%, and then your CAC payback is over 24 months, and most importantly, your burn multiple is over 2, right? So if that's where your metrics are today, it's very beneficial to like actually just like, hey, like, how do I quickly switch? How do I change my strategy? How do I change in order to at least move towards becoming good over here? But your thoughts on like, hey, what they actually mean by why? What are your thoughts on why a combination of this is actually very important in this downturn, and how you actually measure a good company?
I think you made a very good point. While this chart summarizes a lot of things about what you're really doing in your business, right? Because whether it's liquidity pulled off or excess liquidity, you should definitely focus on business. And I think one thing that we'll start seeing in business is what you were saying, right? Become more metrics oriented. Track your metrics very well. Just don't go for growth and ignoring your burn multiples or just burning a lot of capital, right? You should always check, obviously growth is important, and more so in today's world. So, the growth metrics are becoming more and more stringent. But more important that becomes is, what is your tax spend for that? Are you able to manage your burn and your runway for that, right? I think that you see on the left here, the grade, there is a reason for that, right? Like, and a lot of good quality SaaS company that you see, right, like will fall under the grade bucket, to be honest, right? Or would want to definitely be wanting to, right? Like at least in the strategy or the plan. Because at the end of the day, you can't keep putting money and burning a lot of capital, right? The essence, I think, like net dollar retention becomes very important because if you can retain customers, growth obviously is the one. But I think the last multiple that you see here, the burn multiple, is a composite of all other multiples in there, right? And if you want to throw some light shade on that, then I can talk about it a little more.
Yeah, I think this became famous in the last like 3 months or so, but I mean, like, the essence of a burn multiple is the amount of net new ARR you're acquiring by the amount by your net burn, right? And what that essentially means is now you can actually dictate how much are you spending in order to acquire new revenue, right? And it's a great way to just measure your efficiency as an engine, right? Like as a GTM engine, as a company as well, just to measure your efficiency. So if you see here, if your burn multiple is 1 or less, then essentially you're burning 100K to, say, acquire 100K in revenue. That's great, right? That's almost like your cash flow. Your cash flows are actually even. But if you're good, like that is, hey, like you're burning 1.5 to acquire, like you're burning $150,000 to acquire, say, $200,000 of revenue, or sorry, $100,000 of revenue. That's also pretty good, right? Because you're still growing, you could still spend that money and it's effective. But if you're over 2, that is, if you're spending $200,000 to acquire $100,000 in revenue, that's when if you're growing at 4x or 3x and you're doing over 2, and you're an early stage company and you need to invest this in the first 2 quarters in order to get to a stable state with burn multiple, that's perfectly fine, right? But like it's very important to keep measuring this over a course of a year, just to see what is the thing in like, if you just take it for a C stage company that's just raised money, or a Series A company, you'll always spend a little bit more in the first quarter or 2 to ramp up your team, to enable all of that with the new money that you've actually raised or not, right? So that's that's what we wanted to convey as well. I think anything you want to add over here?
No, I think very pertinent point, right? Like as you said, your burn multiple is 2, right? Like, and if you're growing at 3x, basically you're spending 6x for that, right? To grow to that 3x roughly in absolute terms. So while you're growing 3x, you're additionally burning 3x, right? And when you know in the current scenario why it's becoming so and so important is because we know, equity is not easily available. Obviously there are alternate forms that you can explore, but you need to be more and more frugal, right? Like to see whether this growth is sustainable or not.
At the end of the developer has developed few.
Yeah. Sorry, Eklavya, is that?
Sorry. No. Yeah. No. So I think that's what is most important, right? Like to focus on your net burn as well and see what your runway is, right? Like, and just not spend anything. Measure your ROIs for every activity. I think just don't do it for the sake of doing it because it looks glamorous, right? Just see whether you are a B2B business, whether you're a B2C business, right? And in B2B, whether you're an SMB enterprise. Try and classify various spends and various activities and measure ROIs before you delve into anything.
But
right?
yeah, and the funny part is, this is how we used to operate before 2020. It's just like 2 years of all our discipline is left us. Like now, I mean, we're just going, it's like we're relearning how to operate in an efficient environment, or in a capital, where capital isn't that freely available as well. Actually, we have a poll question as well, just to get an understanding of where you guys are, and what's actually bothering you today, right? What's going on in every space per se. So I think I'll give you a couple of seconds to couple of minutes to just reply, and then we can kick it off. Eklavya, can you see any questions from the audience as well in the meantime?
Yeah. I think there is one question where it says, do we have SaaS industry benchmarking on spend analysis, like customer support, sales, marketing, R&D product? So I think that's a very good question, very important. Would love for you to take it. We do something at Recur, and I'll talk about it. We are trying to build something to enable the ecosystem. But anything that you want to say before I jump in?
Yeah. Spend by department is a great way to look at it from a SaaS perspective. But actually, to be honest, the spend by headcount is a better judge of like how you're actually operating, right? Because when you're budgeting for a headcount, the general rule of thumb is you take 7 to 10% over that headcount, the annual CDC, and you take 7% or 10% over that as their SaaS spend. Is a good way to look at it. It's just a heuristic that we use to operate, but also a lot of our customers use to operate when you're budgeting for headcount. And that way you will never be surprised with the SaaS spend that you're seeing. At least you know that you've budgeted for it, whether you're still getting a good deal for it, whether you have 100 different tools, you have like duplicates, all of that is secondary at that point, but at least you know that you budgeted for it. That's a better way to look at it. And it's really hard to, depends on the size of the organization you are, your SaaS spend by department could differ. Right. So if you could tell us like which size of an organization, what the size of the organization is, I'll be able to answer more specifically as well. Ani,
I think you may.
Sorry, yeah.
Sorry, please.
Are we done with the poll, Ani? Should we go to the next slide?
Yeah, sure. So we have the poll results.
You want to just put it up?
Yeah, sure.
In the meantime, there's another question. Do we also see a trend where customers are looking to buy now, pay later in SaaS or cloud spends to conserve cash?
Correct. Let me answer that as soon as we go to the poll as well. High CAC, high receivable cycles, high customer revenue churn rate, with SaaS expense in your organization, the other thing. Okay, yeah, I think all the polls got released at the same time.
Yeah.
But yeah, like I think it seems like the high receivable cycle is always it's always a catch-22 if you're not billing upfront. And high CAC, just efficiency over there, right? So it's just good information for us to have as well while we go through this. I think to answer Abhi the second question on whether we can the buy now pay later for all your SaaS tools as well, and as well as your cloud costs. Like I think if you for the SaaS or the cloud spend that you can commit to on a yearly basis or even for a 2-year commitment, where you know that, hey, this is my base level of consumption and this is what it's going to look like for the next year, and you're really confident in that commitment. Hello?
We can hear you, Sid.
Yeah, okay, cool. When you're really confident in that commitment, in that with your spends, especially when it comes to SaaS or when it comes to like even your cloud spends as well, it's great to actually go annual. And you don't necessarily have to pay annual. There are, you can actually enable buy now, pay later for those spends as well, where you can actually commit to that annual upfront, get the discount, get the benefit of being an annual upfront type of customer, but pay out monthly as well. You might you end up like losing a little bit of a discount because you're paying monthly, but apart from that, I think it's a great way to like actually just conserve your cash flow for a lot of the spend. You can't do it for all your spend, but you can be strategic in the spend that you choose to do it for. And strong suggestion is to do it for the spends that you're going to commit to for the next year or two as well.
I think you made a very good point, right? Like, and I think the question is very pertinent. If someone is offering discounts, right, especially large enterprises would typically do that. Take leverage, right? Like if you anyways know you are hooked onto the product, take leverage if people are offering that, and use like the MPF process. So we have a lot of companies that come to us, right? Like they started to come to us at Recur. Like let's quote 1 or 2 examples there, which works very well. Is someone is charging you say $1,000 a month roughly, right? Like just to simplify things. So instead of paying the $12,000, they'll say, I'm getting an option to pay $10,000 today. you do that right from a customer point of view, and then we enable those companies to come to our platform, and leverage that kind of BNPL, like BNPL, and that still pay $1,000 and get rather $11,000. So that way you get the discount and you benefit from the distribution of cash flows as a company to manage your burn. So I think it becomes like a no-brainer for a company point of view to leverage that if you get those discounts.
Yeah, very valuable as well. Like especially if you're especially if the annual upfront discount is over. If you're getting anything over 10% or 12% or 15% on your annual upfront payment, you should definitely look at this as an option. That if you're able to get that annual upfront, which is over 15%, that's I think the threshold at which you should start looking at this option as well.
I think that's a very good point because it depends what the discount is, right? True.
Yeah, it's a good threshold to just like look at for most of your spends. And I think some of the challenges that we see as well, I mean, just with a higher burn multiple, I mean, the biggest piece is that you're going to run out of runway very quickly. It's not on this slide, but that's the biggest thing. In order to hit your metrics, the thing that you need really is time, right? You need time to figure out the metrics for your business. It's like where you need to maybe change a couple of things. It might be how you do it, how you sell, how your GTM engine, your product. It could be multiple things, but the only way you can make those changes if you have time. So high burn multiple reduces the amount of time you have actually to operate, which is like my biggest. I mean, we watch it like a hawk. A lot of companies that we work with also watch it like a hawk, right? So what is your Eklavya, anything that you'd like to add over here as well, right?
I think that is very true, right? Like, and especially when investors, obviously as companies, you should focus more and more on the one that we're talking about. Even the investors are watching out for the same, right? Like, if you want to if you need, especially equity guys, right? Like, so if you want that access to that capital to continue, because you will have to be frugal, you'll have to be very pertinent about managing your expenses in the right way, because it's. See, what is the valuation of a company, right? Like a lot of things start coming from different sources. It's basically discounting your future cash flows, right, today. Obviously, you are burning today, but people say you have a terminal value after 10 years and discount that. But I think emphasis on that is increasing, day by day. And that's how it has always been, unlike the last few years that we have seen abnormally. So focus on that and everything will fall into picture, right? Focus on the fundamentals of the business. Focus on maintaining your margins and maintaining your burn, and have sustainable growth. You may not be at say growing at 100%. You need not be. Even if you grow at 50%, it's sustainable. That will help you in the longer run much more. By managing expenditures.
I think we can move forward as well. I mean, this is something that we've started following internally as well, but I think a lot of our customers have also started following this strategy per se, right? Because you'll have to augment your capital with your equity stack. You can also augment it with your with some form of non-dilutive capital. At the same time, you run more efficiently, deliver some continuous savings and continuous capital to your stack, right? That's the key piece over here. As you grow, the amount of capital that you derive from non-dilutive sources should also grow. But at the same time, as you grow, your spend will also grow, but it needs to be continuously monitored and effectively, you have to be effectively saving money on your spend at every stage.
I think companies are fortunate, in today's world to have different options. From a financing point of view, erstwhile it was only equity, right? Like you keep on diluting, which is all everyone knows, right? It's a time-taking process. While it's great, right? Like it gives you great features for your long-term growth, but it takes time, right? Like it takes time, effort to do that. And you may not be equity ready. Hardly 1 or 2% of companies that operate, get eligible for equity at different points in time. But that doesn't mean you're a bad business, right? You may be a great business doing well, but may not be equity fundable at that point in time. So I think the question of how do you become that, right? Like to manage your growth, using that table that we had from David Sachs, saying that maintain your growth, maintain your 1 month, because and I think things will follow suit. So it's a cycle. You don't want to be on the wrong side of that cycle because it's very difficult to come back, right? And it could be in a black hole. So I think what we do, like I was talking, right, like it helps in current macro times, to delay your dilution a lot, right? Maybe not go upfront, and chase equity. There's an opportune time for everything, and especially with the type of expenses. So focus on that and definitely cut on, as Siddhi was saying, on the right expenses. I think that's very, very important for a company at any stage, right? Just because you have money doesn't mean you spend, right? So be very conscious of the fact that what is the real outcome of this, which people, kind of faltered their ways because money was right.
Yeah. Makes sense. I think we have another quick poll question as well. Ani, if you want to just launch it in the meantime, when the poll is getting answered, any other questions from the audience as well, Avi, that you can see?
I think there's one question on given the current macro. I can take that, I think, to start. The question is, given the current macro, every buying cycle is getting extended. So how do investors look at supporting the portfolio companies, and will they double down on growing companies at conservative valuations, or wait to invest at a time valuation is slightly better? So I think investors are always there to invest in companies. I think whether at what frequency, at what aggressiveness is determined by the external factors. So I think flight to quality actually has increased drastically, right? So if you keep on focusing on your metrics, on your business, it will always give you, a long-term sustainable growth where investors will chase and follow, right? I think that's very, very important. So supporting existing companies, I'm sure investors do that, right? Like they have trust in their company, they definitely do that. It's always a case-to-case basis, so you can't generalize it. But I think investors are also in for a long-term game, right? Like while they are financial investors. So I think what I hear and understand, in fact, a lot of VCs that I was speaking to in the last couple of months, they said maybe they are not doing any new investments, but definitely supporting their existing companies, right? At the right time, at the right place, because investors also want to grow that business, right? They don't want that business to fall down. But investors are always, they will always want to get the best values. So they will always opportunity time it, relative to the market. And valuations are not going to get better very soon, right? What we are discussing. It's not that in 3 months down the line or 6 months down the line, valuation suddenly jump up and say, hey, it's back to normal, right? It takes time. It's typically like a Nike chart where everyone says, right? Like it falls down always sharply and then it takes time to get back. It is right time, right? And if your metrics are good, I think, in fact, better quality companies may actually come out as, winners in this market because there is capital. If you are a good company maintaining your metrics, you may come out as, even better valuations as possible.
Yeah. Awesome. Do you want to put up the results as well, Ani?
Yeah, sure. I think everyone has not answered yet. Should we wait for a few more seconds? Okay.
Sure. I think in the meantime, we can just jump into a case study as well, right? And done. So, what we do at Spendflo really is that we kind of we centralize all your SaaS spend in one place, give you visibility into your spend as well as your usage on these tools, and then the best part is we use our benchmark data to enable guaranteed savings on all your SaaS spend, right? So, with the biggest problem with SaaS is that it's opaque pricing, right? And especially when you're buying decentralized buying, that is everybody within the organization is actually buying these SaaS tools. It gets really hard to figure out, hey, how much should I pay for it, and what's the procurement process look like within the organization to actually do that. So in that process, what we've one of our customers, it was over 60 different tools that we'd actually procured for them over a period of a year. And it was a very non-standard process, but now procurement happens about like 3x faster, right? It's like you can come request for the tool in the platform, go through approvals. The entire approval process actually happens there, and you can actually get the savings along the way. And you also save a lot of time in the process, rather than your department heads actually spending all of this time and effort. You'll actually have like a dedicated buying team who's actually doing the buying on your behalf to enable the savings. And this way, what happens is that you actually have a dedicated process and dedicated data and systems to empower your end stakeholders to make the right decisions. And that's the behavior shift that happened. When you're buying a lot of SaaS and you're renewing a lot of SaaS, it's the end user that decides what's the volume, how much they want, how much they want to pay for it. And that's what we are enabling at Spendflo, right? Is to enable you to provide your teams with the right data and the right systems to move forward. Sorry, do you want to take it over from here, Eklavya? Anything else that you'd like to add on the next week as well?
No, I think that's very well said. And there's a lot of use cases that I personally want to understand from you, right? Like maybe today, maybe separately, right? Like, because it's always a question, right? Like they're so ubiquitous, right? Like we are relatively a younger organization, right? Like 1 year into it, and we have so many tools, right? We were discussing in one of our team meetings last week that there's so many tools. Are they being used or not, right? Like every month it gets deducted from a subscription, you don't realize. And then you see, oh, are you really using that? We tried doing that, right? Like obviously our scale is small, so we could have just said, okay, we are a 35-member team, we use 35 subscriptions. And there is a lot of duplication even at our scale. So I can just imagine, with companies growing, what it is like and what are they really spending on. But every money saved is money earned, right? At the end of the day, US is effectively boosting your cash flows. It's very, very interesting. I think we have another poll. If we can answer, we can give them a couple of minutes on, or like in the audience, what are the kind of companies that we have, especially in terms of their annual recurring revenue. I think it was answered initially, but sorry for the duplication. If you guys don't mind, whoever is there, if they could re-answer, that will help us align as well, in terms of what strategies, because every growth capital, non-dilutive growth capital, as well as cost spending, varies per the size of the company. It is not one suit fits all, and hence this request. So we'll wait for maybe a minute or so to get people answer that. And then we'll discuss one interesting case study, to show various use cases where non-dilutive growth capital can help you grow your ARR, while not diluting equity, and then maybe dilute later at a low valuations. We'll come to that. We'll just, I think, wait for a minute. That's okay.
Sure. Any other questions in the meantime from the audience as well?
No, I think people are already bored.
Yeah. They're like, they hit their threshold. It's like,
but feel free right now, or even after, right? Like, feel free to reach out to both the Spendflo and the Recur team. Like, we will discuss case by case basis if you want, right? Not here, and we can use this forum as well. We have some time once we proceed. We can take a specific case study if you don't mind, and discuss that if anyone of you has a particular question.
Awesome.
Cool. If the poll results are there, I think we can proceed. Cool. I think, so if you see here, I've taken an example of an HR tech SaaS company. They started funding with us sometime last year. It was a $3.5 million ARR HR tech SaaS company, bootstrapped till date at that point in time. Was going well, right? 20%. Don't need to have too much of equity capital or other requirement, because maybe the motivations were different, right? And when we met the founder, right, he said, I just don't want equity, right? And I'm happy. And we discussed the solution, and he took non-dilutive growth capital for his recurring revenue subscriptions. We were able to provide him like $1.5 billion of growth capital to them. which helped them to actually grow 70%. What we didn't realize was because we saw their metrics, right, like LTV to CAC and other things, which are pretty solid. And by putting money in CAC, they could accentuate the growth to almost 1.7x in the next 9 months. And eventually what happened, right? Again, they took financing 3 or 4 times from us during this period of 9 months. It gives them the flexibility of when they want to spend on their CAC. So there's no additional cost. So they're not diluting, they're getting money, say within a week, hassle-free, by leveraging tech platforms, while we are integrated into their financial software and invoicing softwares and banking data, which could instantly give them a limit within a couple of days, and they loved it. So in the 9 months, they grew 1.7x and they got an inbound offer from one of the VCs, one of the marquee tier 1 VCs active in India, and they got an $8 million equity check straight up. They're very happy, right? And they actually did that transaction, right? So it's a classic case of actually, delaying your dilution or not diluting at a point in time. And when you grow your revenue, right, you can get much higher valuations than expense per dilution. I think a very important point that people miss at times, right? Even if you save 3 to 4% of your dilution in every round, after 5-6 rounds, right? Cumulatively, you can save around 10-12% of your initial equity, right? And if you become a unicorn after that point in time, hopefully all of us on this webinar do, right? They end up saving $100 to $150 million of shareholders' value, right? Which is your own personal net worth. The company is still valued like $1 billion, but you save $100 million of capital, right? So it accumulates, right, over a period of time. So value that, and there is a end use for every type of capital, right? While it's great to have equity, great to raise your valuation, great to have valuation discoveries, one needs to know, what should the equity capital be used for? If it is a predictable expense where the payback period is very high, say 18 to 24 months, or it's an uncertain activity like launching a new product, launching a new market, right? Or you don't have revenue. Equity makes perfect sense, right? It's what we call as installment period for every company. But once you stabilize, once you have predictable revenue, these are the channels that work for you, right? So to spend on your CAC, ideally you should not be using equity. And hence a solution like us come into picture, where you fund your CAC through us, keep on rotating, keep on growing, and then double down on your ARRs to maintain that growth. So I think that's been a lot of use cases that we have seen for our portfolio companies and others that we are speaking to.
Awesome. Any other questions from the audience as well in the meantime? And I think what we're really trying to say is you can actually boost your ARR with the non-dilutive capital from Recur, help you enable savings on your SaaS spend as well through Spendflo, and essentially you have that stack to grow faster with that ideal bulk multiple, right? Every month or every couple of months, you shouldn't be on the lookout for how you do this. You shouldn't be on the lookout for how you do this every year as well. You should just have access to all of this on tap, and you should be working with partners who can enable this for you as well. So that's essentially the essence of what we're trying to get to in this era. But I'm opening it up for questions or any other thoughts as well from the audience in the meantime. Eklavya, anything else from your end that we really need to cover?
No, I think we'll wait for any questions. But I think the sum and substance is, don't stop your growth, because that can be limited. Leverage this opportunity and the options that you have today, right, in terms of alternate financing and reducing your spends to focus on the right growth areas. I think as a CFO, as a founder, you would really understand and appreciate how important it is, to have that extra 3 or 6 months of runway at current time. Right? If you're at 12 months and 15 months, it makes a whole lot of difference in your mindset, in your business strategy. So be very pertinent right from get-go and leverage the solutions that are there in the market.
Makes sense. Awesome. Any other points from the audience that we really need to cover? Avi?
I think one point that someone had asked about, spend analysis that you're talking about on various heads. in terms of customer support, sales, marketing. So I think what we are trying to do, we are launching like a product report because we have evaluated more than 300 plus companies today, right? With primary benchmarking data of how they are spending, and we are doing some analysis at our end, right? And it was interesting that a lot of people have cut down directly on their G&A. The CAC spends were reduced slightly, on overall basis, like a percentage or two, like it was around 25%, the number was around 20 to 23% over the last 6 months. But the G&A spend had dropped down significantly, 10, 12% or so. So one needs to be very particular, and from that about where they are actually spending. And just because there is a slowdown, don't go and directly cut your G&A, right? See your various CAC activities are they producing. And majority of the G&A is salaries, right? Let's be honest. Majority of G&A is different salary that we have. So just don't go right after, figure out, what's wrong. Are you spending somewhere else, or are there CAC initiatives that are not yielding that much? So be very cognizant of the fact and just not go after cutting salaries, right? And definitely leverage Spendflo, to cut down on the right expenditures, other than just because it's not right. I think because that's the easiest to do. So I think a lot of companies tend to choose that. It's always easy if I have 50 people, we fight 10, right? Easier said than done. But that's the easiest rather than you don't have to get down to details, etc. So I think be very meticulous. Don't fall into that trap because you have to grow, right? You will need people to grow again. You will need different heads. So plan for your long term and spend judicially and raise capital judicially. Don't be just in a hurry to take decisions.
Great. I think if nothing else, I think we can we can close this down. Awesome. Thank you folks for joining. It was a pleasure connecting with you, all of you. And thank you, Eklavya, for putting this together on the Recur team on just getting all of this together as well. Thank you guys.
No, thanks. Thanks everyone. Thanks Sid, and thanks the Spendflo.
Thanks, Siddharth.
Look forward.
Thanks.
Bye.
Siddharth.